On July 4th, while we had fireworks in the sky, something a little bit more explosive happened. Congress passed the One Big Beautiful Bill, and the president signed it into law on July 4th. And if you haven't heard about it yet, then you're about to realize why you should. So what I've done here is unpack the OB3, as I'm commonly referring to it as, talking about what it covers, why it's historic, and how it could reshape a lot of different things, everything from healthcare to climate policy. There's some additional stuff with tech regulation and all of that. It's a really big bill, and it includes a lot of things. People have lots of opinions, and I'm not here for the opinions. I'm just here for the facts. What I'm going to cover, because it's specific to my world, is what is related to tax policy that was included in the OB3. So I'm going to give you my top 10 of things that I think are important for you to understand and how this impacts your daily life. The first thing that happens, essentially, the OB3 has just extended the 2017 Tax Cuts and Jobs Act. And so it has taken the provisions from the TCJA that were set to expire at the end of the year and essentially made those permanent. So we're talking about things like personal exemptions, dependent exemptions, the changes that happened there, and the tax rates that had been in place from previous. What does this mean in practical life? Basically, this means that things stay the same. So what's important to understand is that if you have been on a specific plan and nothing in your world has really changed, now this just makes permanent that nothing should change. So that's good news, because that just means that we can plan a little bit more clearly into the future. And so this really kind of makes permanent those tax cuts that were given back in 2017. The second thing that happens is we have an enhanced child tax credit. If you have kiddos, you're going to now see the $2,000 child tax credit go to $2,200, and then it's going to now index with inflation. Why is that important? Well, I mean, if anybody has kids, we know that kids don't get cheaper. What's going to happen now, we're going to be able to continue to see that enhanced child tax credit grow over time. And so that's going to happen in the coming years. Number 3. This one's new, and this is kind of cool. If you're a typical service worker, so we're talking our servers, our bartenders, our hairstylists, things like that, people who receive tips and have traditionally been in an industry where tips are normal, we now have a provision just for 4 years, basically called no tax on tips. How does this look in practical life? Well, these tips have to be first off reported. It's important to understand that if you had traditionally not been reporting your tip income as income, that is not correct. You're supposed to receive that and report it as income. Now, if you report it as income and receive it as income, you'll still pay the additional Social Security and Medicare on the tips, but you're going to be able to deduct up to $25,000 of those tips off of your tax return. It's going to be what we call an above the line deduction. Why does that matter? Well, it matters because some people itemize and some people don't. If you get a deduction above the line, above that line of itemization, as we kind of call it in the industry, that means that you're going to get this deduction even if you also get the standard deduction. That's important because that helps a lot of people who maybe aren't going to itemize, but they're now going to also be able to take this no tax on tips. So this is an above the line deduction. It's going to come in before we start talking about our standard or itemized deductions. Number 4, SALT. What the heck is SALT? It's getting a lot of newsworthiness because SALT, state and local tax, is something that in the previous Tax Cuts and Jobs Act affected a lot of people who paid a lot of taxes outside of the federal government, particularly people in states where either the real estate taxes or the state tax rates are very high. What happened was with the old Tax Cuts and Jobs Act, that cap had been $10,000 a year. For a lot of higher earning individuals, that $10,000 was a huge reduction to the amount they were usually able to take as a deduction on their tax returns. The new enhanced state and local tax or SALT tax increase has been taken all the way up from $10,000 to $40,000. for married couples who are earning up to $500,000. Is this going to help everybody? No, absolutely not. But will it help some people, particularly those who are up to that $500,000 limit? Yes, it will. And so that's important to include. If you're somebody who falls in that range where that SALT cap was hitting, now maybe you're going to get to take advantage of this increased SALT tax deduction. This is an itemized deduction. Whether we standard or itemized deductions, we now may see some people roll back into itemizing, whereas before they had been in the standard deduct world for the past several years. Number 5, auto loan interest. This one is very new, so we haven't had anything like this for individuals. If you have a commercial vehicle and you have an auto loan, you've been able traditionally to take the deduction for the loan interest because that was a business asset. But in the personal world, this hasn't been a thing. Now we can deduct up to $10,000 a year in automobile loan interest for a vehicle that we buy in this current year. So this is going to be between 25 and 28. And the vehicle has been final assembled in the United States. So again, this is important to understand that this is not all auto loans. This is very narrowly focused to focus on people who are buying loans, taking out loans on cars that are final assembly in the United States, encouraging domestic production. And this is only a 4-year holiday where we're going to get to take this. This was a temporary provision that has been put into this new bill. This also has a phase out. It's going to phase out for anybody starting to earn after about $100,000. So this is aimed very much specifically at a certain demographic. And again, this is an above the line deduction. So this is one of those deductions that we're going to get to take whether or not we itemize or take standard. Number 6, the senior tax deduction. This one is getting a lot of headlines. It is not no tax on Social Security. What this is an increased deduction for individuals who are age 65 and older. It is $6,000 per person, and it is only in place for a 4-year window. This also has a phase out for individuals who are starting to get over $150,000 for those married couples. So again, we're not going to see this eliminate a lot of people's Social Security, but it might include more. And so if you are currently collecting Social Security, it's important to understand that the way that the tax law has been and continues to be is that there's a tiered system for where you pay tax on certain levels of your Social Security. If you have no other income other than Social Security for which you receive annually, then you likely are not paying tax on the receiving of that Social Security. But as you go through these different phase-out periods, if you have other sources of income, you generally are paying tax on up to 85% of what you receive in Social Security. So now what this additional tax deduction does is comes in and tries to mitigate some of that tax burden. However, it's important to understand that the qualification for this deduction is your age and not actually whether you're receiving Social Security or not. That's an important distinction that I think we need to understand. Just because you're on Social Security, you might be under age 65, in which case you're not going to qualify. You also may be at age 65 or older, but not yet collecting Social Security, and you would get this deduction. So this is for seniors. Seniors are defined as age 65 and older, and it's a $6,000 deduction that's going to come off of your income, again, above the line before we start itemizing and taking standard deducts. Number 7, we now have an increased exemption for estate taxes. So the way that this has worked is that we had an increased estate tax exemption that was in existence with the old tax law, and it was set to expire. Currently now, with the passage of this bill, this is going to take the estate tax exemption up to $15 million for an individual and $30 million for a couple. What does that mean? This means that if I die with $15 million or less in net assets, this is a value-based tax, then my estate is not going to have to pay inheritance tax on the value of my assets. And this now estate tax exemption is going to start to increase with inflation annually after 2025. And the intention here is to ease the tax burden on wealth transfer between generations. So I love this. I think this is really helpful because if you're not in a case where your family or your personal net worth is in excess of $15 million, again, we can now breathe a little bit of a sigh of relief because what we die with, we're going to be able to pass to our future generations without having to pay the estate tax. Number 8, we have now made permanent with the OB3 the QBI deduction. The QBI deduction, or qualified business income deduction, is for pass-through business entities or personally held business entities such as sole proprietors and rental properties. And this is a 20% deduction that has been in place since the 2017 Tax Cuts and Jobs Act. The OB3 now makes the provision permanent. This is really big for small business owners and the Main Street business community. Why? Because we were facing the potential of losing this additional 20% pass-through deduction, and that would directly impact a lot of our small businesses in our community who, by having this deduction, are now allowed to remain competitive with large corporate, because the corporate tax rate, remember, that dropped with the Tax Cuts and Jobs Act, but we didn't make permanent the one that helped small business. This now makes permanent the one for small business, which again equalizes as much as possible between large corporate and small business community. So I think this is really, really helpful, and it allows us as small business owners to gain a lot of assurances in the way that we proceed with our businesses because we kind of know what's coming in the future. This was a really big concern for a lot of people in the small business community because if we lost this, we were facing a very massive tax increase after this year. Number 9, we have now made permanent with the OB3 100% bonus depreciation. What does this mean? This means that businesses who employ capital into certain fixed assets, fixed assets might be machinery, might be qualified improvement property, might be land improvements, things like that. If we put those things in play in our business, we put them in service, we're going to be able to deduct immediately up to 100% of the cost of those new fixed assets in the year that they're placed in service, so long as they went into service after January 19th, 2025. And so this one kind of retroacts a little bit to almost the beginning of 25, super helpful for most of our small business owners. And we're going to be able to take 100% bonus, if that makes sense, in year 1. Now, what I'll say is that doesn't always make sense to everybody. So remember to consult your tax advisor to understand whether 100% bonus is in your best interest. There are situations where it does help. There are other situations where it does not, and that's a super dependent factor. But the ability to do it has been remained in the OB3. And number 10, something new that we've not seen before is what's being called the Trump accounts. These are a brand new class of long-term savings vehicles that have been established for our youngest Americans. And so for individuals under age 18, this is now in play. And furthermore, for any new kiddo that was born between 2025 and 2028, the government is going to make a one-time deposit into these Trump accounts. And then there's going to be annual contributions that individuals such as parents, grandparents, aunts, and uncles can be made into the account, capped at $5,000 a year per beneficiary. The investment earnings are going to grow tax deferred, and then the kiddo is going to be able to use these after age 18 for qualifying purposes, such as higher education or also a first-time home purchase. So this has a much broader use than our traditional 529s. And in addition, these accounts are going to be able to be invested into a broader range of funds. So you could theoretically invest this into the S&P, whereas 529 plans currently do not have the ability to be unrestricted in what they're invested in. They are determined by the state in which they're employed. That is my summary of a top 10 things that's happened with the OB3. I hope that's helpful to you. And if there are other provisions or other things that you're hearing, I would love to answer those in a follow-up video. But I hope that this helps you kind of get a baseline foundation for what might be on the horizon for the OB3.